Suddenly everybody wants silver. Modi now turns around and says to the people, please don't buy silver for at least a year.
Right.
When you have very low open interest, and in silver's case it's the lowest for 20 years, what this means is that there are no bulls in the market. Why are there no bulls in the market? Silver, these markets basically are seizing up, is the short answer. Completely mispricing gold and silver. Who gives a damn what's going on in gold and silver? But when gold goes up, I think that the smaller investor is going to turn around and say, I can't afford to pay $6,000 for an ounce of gold, but I can afford to pay $100 for an ounce of silver, or whatever the figure is. I can see a rush going into silver, if you like, once gold starts going up. Mm-hmm. Will gold go up? Of course it will, because what's going on is our currencies are going through the floor. We've got massive and growing industrial demand because of all this ECG stuff, photovoltaic cells. The military, which has expended virtually all its ammunition, it's desperate for silver. The investors have hardly started. There are these prices all over the place, and this is particularly relevant, I think, when it comes to the pricing of gold and silver. We have seen for a long period of time gold and silver migrating out of America, out of, I suppose, Europe as well, going into China. There is obviously a different price in China compared with us. Otherwise, you wouldn't get that flow of metal. Now, I know that there are all sorts of reasons why there should be a price differential. There's imported silver, for example, as I understand it, into China suffers a 13% tax. So you've got to pay the tax before, so that accounts for the premium. But nonetheless, the metal flows. And that tells us something very, very simple. And that is that we are underpricing the stuff over here.
Yeah.
And it's getting to the state where, the available stocks are really being drawn down and down and down. And there will come a point when suddenly you open the vault and it's empty. You think, oh my God, we promised to deliver this stuff tomorrow. Where is it? That sort of thing. I'm dramatizing it a bit.
But still.
I can see, we had this situation. It's fascinating. Let me go back a little bit, because the situation was shown into sharp relief when President Trump threatened China. I'm going back to last September, threatened them with 100% tariffs. So China turned around and said, okay, no rare earths. We're stopping rare earths export, or we're controlling it, if you like. Mm-hmm. And immediately Trump backed down.
China is paying a premium for metal while the West keeps insisting prices are fair, and that contradiction should concern every investor. As Alasdair Macleod points out here, physical gold and silver continue flowing east despite taxes and transport costs, signaling demand far stronger than headline prices suggest. Markets rarely ship scarce assets away from where they're supposedly valued correctly. For savers, the real risk is discovering that quoted prices reflected paper abundance while physical inventories were quietly disappearing. Next, Alasdair Macleod exposes the overlooked silver shortage signal that emerged just weeks after a major geopolitical standoff.
What we didn't know at the time was that some sort of similar policy must have come out on silver, because literally within 2 weeks of that, 3 weeks probably tops, on the 9th of October, there was a huge, great shortage of silver, deliverable silver, appeared in London. And we had a lease rate that jumped up to 40%. And of course, that was the beginning of the run in silver, which went all the way up to, $120 before, sort of the parabolic spike, as it were, showed some signs of faltering. So China is still exporting silver, but I would believe that silver being exported is, if you like, under long-term contracts which have already been agreed. So that can't stop. But China has returned into the market as a buyer of silver from the West. You can see the from customs figures, the amount of silver going back into China exceeds its exports by something like 3 to 1. Mm-hmm. Now, China is a major producer of silver. Not only is it a big miner, it's a lot smaller in mining terms than, say, Mexico. I think it's probably number 3 to Peru. But because it imports non-ferrous ores for refining, I mean, that's really where 70% of the silver comes from. So, they have been hoarding silver for a hell of a long time. And the situation was not helped internationally, if you like, in terms of availability of silver, when America decided that silver was a critical mineral.
Right.
A 40% lease rate is not normal market behavior. It's what stress looks like when physical supply suddenly matters. According to Alasdair Macleod, London's deliverable silver shortage appeared shortly after rising geopolitical tensions, yet most financial coverage focused elsewhere. Institutions pay attention to metal availability long before retail notices price moves. If strategic buyers are accumulating, while governments classify silver as critical, investors should ask whether official pricing reflects actual scarcity. Next, Alasdair Macleod reveals why industrial demand may be colliding with a shrinking pool of available physical silver.
Now,
Right.
whether China going to supply America with its critical mineral at a nice cheap price? What the hell is that? That wasn't going to happen.
Probably not going to work that way.
Yeah. So you can see that suddenly everybody wants silver. And we're talking about the real stuff. We're not talking about the paper stuff at all.
Right.
If you can buy paper and get delivery, then you might want paper. And that indeed has been happening. India, I mean, this is a farce. I mean, it really is. The government put in subsidies to encourage industry to start producing photovoltaic cells, have 50% of its energy coming from, solars, whatever. Because it was, on the other hand, it was still building coal-fired power stations and all the rest of it. So you get something like Reliance Industries, who put some huge amount of investment into solar panel production. So they become very, very large importers of silver. Where they get it from, I don't know. Stand for delivery on COMEX, maybe. Stand for delivery in London. Anyway, Modi now turns around and says to the people, please don't buy silver for at least a year.
Right.
What a joke.
I'm keeping you longer than I promised, but I got to ask you one more question about all of this. Is this what's being reflected in the open interest of contracts on the COMEX? Because gold, you would think, I mean, we're at these record prices, silver's, above $50 and has been now for 8 months.
Governments want more solar capacity, more industrial output, and more strategic reserves. Yet somehow silver is still treated like an abundant commodity. What Alasdair Macleod is highlighting is a growing divide between paper market assumptions and real-world industrial consumption. When nations subsidize silver-intensive industries while warning citizens away from ownership, the narrative begins to fracture. For wealth preservation, that contradiction matters far more than short-term price volatility. Next, Alasdair Macleod unravels why record prices are being accompanied by historically weak futures participation.
You'd think that the demand for contracts and exposure, even speculative exposure, would be through the roof, and yet both gold and silver open interest are at multi-decade lows. I mean, levels not seen since 2005. What's the deal?
Well, you raise a very, very good point, because when you have very low open interest, and in silver's case, it's the lowest for 20 years.
Yeah.
What this means is that there are no bulls in the market. So why are there no bulls in the market? I guess if you go to a market maker and you see the screen price, let's say it's something like $75 or something, and he makes you, he says, well, you can buy it at 78 if you want.
Yeah.
In other words, I think they're deterring business. Why? Because the word is out. You mustn't be short. The word is out amongst the bullion banks, the market makers and all that. They're desperate to close their positions down.
Yeah.
And so, I mean, even gold, I would say the oversold condition in gold is 400,000 contracts. We're at what? 367,000.
Yeah.
We're well under. I mean, silver, these markets basically are seizing up. It's a short answer.
Yeah.
And I think it reflects a very, very simple fact. And that is they're completely mispricing gold and silver.
Mm-hmm. Mm-hmm.
You know, I mean, it really is as simple as that. If they were pricing it correctly, we would see good volumes, buyers and sellers, decent open interest. They'd be trading it. They wouldn't necessarily be running huge, great short positions, but I mean, what they would be doing is they'd be trading it and making a lot of money on the trades.
Markets are near historic highs in precious metals, yet futures participation sits near multi-decade lows, and that timing is deeply unusual. Alasdair Macleod's argument suggests experienced players may be reducing exposure to a system they no longer fully trust. If liquidity fades while physical demand strengthens, price discovery becomes increasingly fragile. For investors, the danger is assuming a quiet market means reduced risk when it may actually signal mounting structural stress. Next, Alasdair Macleod reveals the hidden incentive driving bullion banks to avoid aggressive short exposure.
And, you know, that's what they've been doing until very, very recently.
Yeah.
So I think that's the answer to the conundrum. And I think they've probably got the same problems in London. The figures there are less available, let's put it that way.
Even less available. It's just the strangest thing. Even the hedge funds, you know, the smallest positions they've had in years. And like I said, overall, if you add up all the contracts down the board, is the lowest in 20 years. And it's like the exact opposite of what you would expect. And it just makes you wonder if they're, you know, the participants, let's put it that way, are questioning the integrity and why even horse around with these exchanges.
Yeah, I think the other thing, Craig, that you've got to just bear in mind is, you know, what are the vested interests of the players in this market? If you're short, you want to see it done. So basically, what the guys who are short of, say, silver or gold on COMEX futures, if they see a bit of news which allows them to bang the price, they'll do it. Yeah. They'll hit it very, very hard. If they see a bit of news which, you know, might generate a bit of buying, they'll just mark the price up to try and to squash it.
Yeah.
And this is why the open interest has remained so low, partly. And I think also they've widened their prices considerably. Mm. So, you know, that's the way it is. You know, it's the way markets work.
Markets are near record prices, yet total participation has collapsed to levels not seen in 2 decades. And that is not a sign of confidence. This is where Alasdair Macleod's thesis shifts from price action to trust itself. If hedge funds and professional traders are stepping back from exchanges, the issue may not be valuation, but faith in the mechanism setting valuation. For wealth preservation, that distinction matters because broken price discovery can reprice assets violently. Next, Alasdair Macleod exposes why market makers benefit when investors mistake volatility for true value.
I mean, I remember in the London stock market in the days when we had jobbers. You know, we knew jobbers. I mean, we dealt face to face, so we knew these guys, and we went out and drinking with them and all the rest of it. So you learned how they worked, you know, and they would, you know, if they could see someone coming towards them, they would know probably on this guy's past business whether he was a buyer or seller, and load the price accordingly.
Yeah,
well,
yeah.
Wouldn't you? I would.
Yeah,
we're in the business of trying to make Missoula. You know, this is the name of the game. Who gives a damn what's going on in gold and silver? But if we can turn a few bucks out of it, great,
right,
brilliant.
Right,
just don't get caught on the wrong side.
And people are wising up. And like you said, I think it's interesting that the oil price disparity around the globe has had to be eye-opening.
It does, and absolutely. And I think you raising this point, I think is desperately important, because when you start to look at other paper prices in relation to what's going on with the physical in other parts of the world, you see the same sort of thing. Not as acute, admittedly, but at some stage it could well become acute, and I can certainly see that happening in precious metals. Yeah.
Well, it'll be interesting to see what happens next. That'll be as soon as June. My goodness gracious. We'll get another FOMC meeting in June. We get a whole load of extra economic data. It's going to be another crazy month.
Nobody's talking about how market makers profit from knowing order flow, but that silence is more revealing than any headline. Alasdair Macleod notes that pricing behavior often reflects dealer incentives long before it reflects underlying fundamentals. The uncomfortable question is whether quoted prices represent fair value or simply the most profitable outcome for liquidity providers. Investors focused only on charts may miss the widening gap between physical demand and paper pricing signals. Next, Alasdair Macleod reveals why global commodity pricing disparities could become impossible for precious metals markets to hide.
Now, the answer, I think, one answer, which is slightly trite, but nevertheless I think will prove true, is there's an old adage, sell in May and go away. Well, we've got a few days left in May to sell. Now's the time to sell. What I would strongly suggest you do is when you sell in May and go away, don't just go into currency, don't go into bonds, but go into real money, real legal money. Ever since Roman law basically set real money for us, for everybody around the world. I mean, the reason it came real money in America was it came out of Britain, and the law which you inherited was originally Blackstone's commentary, which was a huge, great tome on all the laws, etc., in Britain, before you made up your own laws. And you made up your own laws, basically, which said gold is money, silver is money, and the rest is credit, confirmed by the great John Pierpont Morgan in evidence to the Congress in 1925, when he said precisely that. Now, in spite of all the propaganda that we've had since 1971, gold is still money, and the dollar is rubbish. So it is pretend money. It's imaginary money.
Right.
It's not the real stuff. And when you have imaginary money, what's its value? Its value depends on the faith that you and I have in it. And if we're losing the faith in it, it doesn't matter what the quantity is, it goes down to zero. If it's not wanted, then it's got no value at all.
Yeah.
That, I think, is where we're heading. And we were heading that way anyway, because I think we were coming to the end of the fiat currency era.
Central banks continue accumulating gold while policymakers insist modern fiat systems remain fully credible, and that gap deserves scrutiny. According to Alasdair Macleod, the debate is ultimately about confidence rather than quantity. If currency value rests on trust alone, then every policy error becomes a threat multiplier rather than a temporary setback. Long-term investors should focus less on nominal gains and more on preserving purchasing power through periods of monetary uncertainty. Next, Alasdair Macleod unravels why political decisions may be accelerating trends that were already underway beneath the surface.
Mr. Trump or President Trump, as he, as you might call him, has just basically hastened the process for us.
Yeah.
I think it's going to happen sooner. I can see a scenario where we could find that the dollar collapses completely within a year to 18 months from now. I mean, I'm not forecasting it. I wouldn't be surprised. But where this is so relevant, I think, for everyone is if you do understand that you've got to protect yourself by having a little bit of gold, an insurance policy or something like that, then fiddling around for a few $100, thinking, oh well, it's just drifting off, and I'm going to put my limit in at 4,200 or whatever. I mean, forget it. You're missing the point. You probably, if you're very lucky and you can spin a coin on that one, you might get some. But on the other hand, if you miss it, next stop is going to be, you'll be chasing your tail all the way up.
Right.
And in silver, this is particularly the case. I think it's there you've got the additional difficulty of very little overground stocks which are not spoken for. And at the same time, you've got massive and growing industrial demand because of all this ECG stuff, photovoltaic cells. And also the military, which has expended virtually all its ammunition, it's desperate for silver. The investors have hardly started. A few guys in Asia and India are sort of collecting a few silver coins and a few small bars and all the rest of it. But, basically, the investment community haven't latched onto it yet.
The biggest risk may not be paying too much for silver, but waiting for a cheaper price that never arrives. What Alasdair Macleod is highlighting is a market where industrial demand keeps expanding while above ground inventories remain constrained. Retail investors often focus on daily fluctuations, yet institutions pay attention to long-term availability. If strategic buyers absorb supply before broad investment demand emerges, today's hesitation could become tomorrow's regret. Next, Alasdair Macleod exposes the overlooked psychological trigger that could push mainstream investors into silver all at once.
That's going to happen, Craig. When gold goes up, I think that the smaller investor is going to turn around and say, I can't afford to pay $6,000 for an ounce of gold, but I can afford to pay $100 for an ounce of silver, or whatever the figure is. So, yet I can see a rush going into silver, if you like, once gold starts going up. Mm-hmm. Will gold go up? Of course it will, because what's going on is our currencies are going through the floor. Mm-hmm. Just because it pauses, it doesn't mean to say it's stopped. It's going to continue at an accelerating rate, which is why bond yields will rise. Equity markets will collapse, sell them in May and go away, and precious metals will have the appearance of rising, whereas in fact they're just maintaining their value.
Markets went up, but confidence in currencies continued deteriorating, and historically, that divergence has not ended quietly. Alasdair Macleod's argument suggests silver's next major demand wave may come not from institutions, but from ordinary investors priced out of gold. The timing matters because retail participation typically arrives after the foundational move has already occurred. For portfolio protection, waiting for universal agreement often means paying substantially higher prices later.